Hey guys, it's Seth and Paul with the Everything Money Channel. On today's episode, Paul, in depth, goes over the difference between the S&P 500 and the Dow Jones, what he likes, what he doesn't, and how they interact with each other right now on the Everything Money Channel. Booyah, baby. Hey everybody, it's Seth and Paul for the Everything Money Channel. Today we talk about the difference between the S&P and the Dow Jones. Now, who is Dow Jones, Paul? Is he handsome? Who is this guy? No, but seriously, Paul is going to, with his tutelage and guidance, he's going to teach you the difference between the two, what they mean in your life, and investing in each one. But first, Paul, as always, smash that like button, pretty please, with sugar on top. Yeah! Because we really need your support. And if you like the content, we'll give you more of it. Paul, take it away. S&P versus Dow Jones. I love you. Go ahead,
I didn't really like how you didn't emphasize the like button enough.
Emphasis?
We need to take a 3-second break to emphasize. And why do we do the like buttons?
Well, the like buttons let us know if you like our channel. It gives us some analytics to see what you guys are liking. And
it also allows me to pay Seth and Don more money.
Thank you, Paul.
Subscribe as well. Okay, so one of the most common things that I hear is when people refer to the market, and they're talking about the Dow Jones. I do not like talking about the Dow Jones at all. And I'm going to explain why, because nobody really understands what the difference between Dow Jones and S&P 500 is. I consider the S&P 500 the market, and most people consider the Dow Jones the market.
Oh, okay.
Yeah, so here are the differences why. The S&P 500, first off, is 500 of the biggest companies by market cap. And market cap is the total worth of the company, taking all of the shares and multiplying by the price. So if a company has 1,000 shares outstanding, and they're $10 each, the market cap would be $10,000, correct?
Yep.
Now, obviously, that's not going to qualify in the S&P 500, but I think, and I'd have to look it up, but I think it's around 2 to 2.5 billion is the smallest company in the S&P 500. And it goes all the way up to 1.5 trillion right now, which is Microsoft and Apple and all those ones. So I like the fact that it's broader based. There's 500 companies, and it's based on the value of the company. So the smaller the company in market cap, the less it's going to affect. The larger it is, the more it's going to affect, right? Mm-hmm. So that's a big thing for S&P 500. Now the Dow Jones, I think is absolutely, I shouldn't say it's useless, but it's only 30 companies. It's considered the leaders in their industries. But the big difference with the Dow Jones is it's the index is based on the stock price. Now, what that means is, so you have 30 companies. Let's say company X has a stock price of $100. Let's say company Y has a stock price of $10. According to Dow Jones, this one affects the Dow Jones 10 times more than this one. This company could be worth more money. Let's say this company X has 10 shares, and company Y has 10,000 shares. Which one's worth more? This one's worth $1,000, and this one's worth $100,000. So which one's worth more?
Obviously
company Y, right?
Yeah.
According to the S&P, this would be 100 times more than this one. Y would be 100 times greater than this one. But according to Dow Jones, X is worth 10 times more than Y, just because of the stock price. And I think that's very misleading. I think that's stupid, because we can manipulate the stock price all day. A company can do a split, which means they cut their price in usually it's 2 for 1, and all of a sudden it affects the Dow Jones greater. And that's why I think it's useless. So when people talk about the market, I always refer to the S&P 500 because the Dow Jones bases it on the stock price as opposed to the market value of the company. The market value of the company is what matters more to me. It's just like when we talk about net worth. When an individual has a certain net worth, don't you really care about what the actual assets are behind the business? What's the value of the company? Of course. And in the Dow, it doesn't care about that. It cares about what the price of the stock is. Now, most people only refer to the price of the stock, right? As you always said.
Yeah.
But when you start to understand investing, what matters to you is what you're paying for the company, and that's the market cap. Now, it does involve the price of the stock, but the market cap is the price times number of shares. That's what matters. When you're buying a company's stock, you're looking at your portion of the price of this company by the number of shares.
Who determines the number of shares out there?
The company does. So the company will sit there and they'll issue a number of shares, and over time they might buy some back, which will decrease the number of shares, or they might issue more shares to make an acquisition or pay off debt or something like that. So the company is going to use, the CFO of the company is going to try to determine, based on the market conditions, how many shares they have outstanding.
So if they create more shares, and then more normal people like us can buy a part of the company. By buying part of the company, our money goes to that company so they can make moves with it?
It depends. If they're issuing more shares, the initial issue of the shares goes to the company. But after that, it's owned by somebody or some pension or 401k or mutual fund or whatever, and then you're buying it from other people and other companies and institutions. But the initial, hey, here's some shares we want to release so we can go do things with the money, that goes to the company.
You said it's healthy when a company's buying their shares back. Describe that.
It can be. So that's a great question also. Stock buybacks are a big thing. So a stock buyback, that's a big thing these days, right? People are talking about buying stock back. Now, I'm in favor of buying stock back if it's the company buying shares back that are undervalued. Because when a company is buying stock back, they're using their cash, right? So they're basically investing their cash back into their company by buying shares back from the market. If the stock is overvalued, they're basically buying overvalued shares. Do we like that? No. We don't want them to spend their cash that we own a part of on buying an asset that is worth too much, that is priced too high.
Okay.
We want them to buy it. We want to buy it when it's undervalued, because they're basically investing their money into undervalued shares, and that's what's important. To us, we want them to buy back stock when they're undervalued. As an example, to keep very high level, if the PE ratio, which is the price to earnings ratio, which is the most commonly looked at metric of value.
How do these two affect each other?
They don't.
They don't.
Now, they share stocks, like the 30 and the Dow are in the S&P. I don't think any of them are not in the S&P, but it's just how they're looked at together. It's just how they're looked at separately. The Dow is the whole 30 stocks based on their price. S&P is 500 stocks based on they're the largest market cap companies.
Okay.
So you want to find stocks. Well, how did we get on buybacks?
I just asked. It's okay.
You don't want to talk about this further?
Well,
bottom line is I like stock buybacks when they're buying undervalued shares, because it makes every current shareholder, they get a bigger portion of the company's profit and the company's cash flow and the company's assets, because they're taking shares away from the market. Does that make sense?
Yeah. So go back real quick to the last screen. So when you're analyzing stocks, you're saying the Dow has nothing to do.
No, I'm not saying that. But everybody refers to the Dow. I'm just sitting there saying, if you really want to look at the market, follow the S&P 500, because has this one worked out over? Of course, even Warren Buffett back in the day used to compare himself to the Dow Jones, but now you'll see he compares himself to the S&P. This is a much better indicator of the market in general.
So do the companies inside the S&P 500 and the Dow, do these change on a monthly, yearly basis? How do these companies go in and out?
Dow doesn't change very often. I don't remember the last time the Dow changed a company. S&P, constantly. It's throughout the year, companies are being added and dropped. Because as you imagine, the smallest companies, like let's say they're the last company, number 500. Let's say it's worth $2 billion. 30% drop in share price for some reason, $1.4 billion. There are other companies between there that'll jump up. So they'll be adding and dropping constituents, as it's called, on an ongoing basis. In fact, there are people out there whose job it is, their investment strategy is to buy companies that are close to the S&P, that are doing well, that they're hoping will come in the S&P, because the second it goes in the S&P, there'll be a lot of buying for it. Because all these index funds and mutual funds have to sit there and get all S&P 500 companies. So they'll start selling the ones that are removed from the list, and they'll start adding the ones that are just on the cusp of the list.
Great.
Good question.
Thanks for joining us on the Everything Money Show, on the Everything Money channel. Follow along, smash that like button for us. And as always, subscribe. Paul, thank you for the insight, S&P versus Dow Jones. And look back on some of our past episodes And we'll be bringing you these episodes twice a week. So thanks, Paul. You're amazing. See you guys.